Yeah, please go ahead, Satya. Yeah.
Yeah, very good evening to everyone. So-called Women Empowerment Team is very happy to welcome all of you for this finance management workshop by Samatva Wealth Management. Today we have Jeyamariappan with us. So Jeyamariappan is a registered investment advisor, well known across many Tamil Sangams in the USA. He provides financial and tax guidance, especially for NRIs who owns assets in US, India, and overseas. So let's get started with today's webinar, and I hand over to Jai Mariappan. Thank you.
Okay. Thank you, Satya. Um, so let me. So Satya, just one request. You can continue to. You can admit the
I'm
attendees.
doing that. Yeah.
Oh, yeah, doing that. Okay. Thank you. I'll. Okay. Um, Good evening, everyone. So for today's session, we will cover this following agenda. I think probably all of you guys might have received this as part of our session invite. So I'll cover the how to manage the bank accounts and how to make the transfer. Because based on my experience, and I'm doing this almost now more than 12 years and helped with thousands of families. Um, what I'm finding, it's very surprising, at least with our Tamil community or even Indian community. When people come attend for the sessions, I'm talking about my clients, they never bring their spouses. I would say 99%, maybe 1 or 2%, they'll bring their spouses to attend the investment or tax planning, financial planning session. Uh, but unfortunately, we are living here, and most likely, I think most of us are first generation, and handling the personal finance is a very, very important item, important steps for women, right? So that's why today's session, I'm based on my experience, whatever I gained, and um, what people are typically don't do the best practices when it comes to personal finance. So those are the areas I'm going to cover. So which is your handling bank accounts, uh, your transferring funds, and how to manage your retirement accounts. Because unfortunately, most of your assets in the US, either it will be part of your retirement savings or it could be a part of your real estate, right? And how to manage those assets, right? Because many of them don't even know how to log in when it comes to the retirement accounts, right? Which is very important to understand how to handle those, right? And also kids' college planning, and more importantly, financial scams. Unfortunately, there are lot of scams. You guys won't believe it. Billions and billions of dollars are getting scammed. The financial scams are happening, right? So I'll cover that. So this is so my profile. So I'm from Tamil Nadu near Madurai. I did my engineering in Coimbatore, CIT, and master in PhD Tech. And I did my MBA finance in the USA from John Hopkins University. And I have a chartered financial analyst CFA designation. And I have the Series 65 license from FINRA and started my firm Samatva Wealth Management, which is a registered investment fiduciary advisory firm. And currently, I'm also providing a lot of summer internship opportunity to kids, high school and college kids, probably closer to 100 kids intern so far. So these internship help them to pursue their interest in business finance and investment domain, and helping many startups, and also actively I'm helping many social contribution like Kiva, girls who invest, those areas. Okay. And with that, I will go ahead and get started on the important topic. So as I said before, so that the importance, many of you may not understand why the women's personal finance is very important, but I'll tell you there are few scenarios. um, the one thing is, you as a community, you guys might have seen a lot of GoFundMe, right? when the breadwinner unfortunately dies, now all the burden will falls under the spouse or the women. So think about, now they are under the huge emotional pain, and on top of it, now they have to handle this personal finance, but unfortunately they have no clue, no knowledge how to handle it because they never handle it, right? That's one scenario. And then the second thing is, um, down the road, right? The life expectancy for women is higher than men. So, so that means at some point, I'm sorry, whoever on the background, please mute your audio. Thank you. So at some point, you are going to basically inherit all these investments, and you will be now responsible for managing these funds on behalf of you and for your family. So as per the research, in the another 10 years or so, almost $35 trillion will be transferred under women, so we'll be responsible for managing all these investments. So it could be your simple CDs or high yield savings accounts or any short-term investments, or your retirement investment, brokerage investments, or real estate properties, or assets in the US or assets in India, estate planning, kids college financial planning, so like that, and managing credit cards. So that there are a lot of things involved, and particularly in the taxes, right? Um, and before, so that's why it's very, very important. I know some people say, okay, I'm sharing my user ID password with the spouse, but I would say that's definitely it's not enough. So you have to do it by yourself. And again, it's not a rocket science. I'm going to cover in a very, very simplified manner. I think you should be able to understand, but you are responsible to do it. Don't just attend the session for an hour and then forget it, right? So I want you to do it. Okay, don't outsource it to your husband. The important thing is do it yourself, so that when you repeatedly doing it, will ingrain, and that's it. Then you'll automatically do it. Again, it's not that complex. Then to start with, there are few basic things I keep on reiterating in my every session. So the first thing is make sure that in your family you have the correct protection. So when I say the family risk protection, what I'm talking about is the term life insurance. So all you need is you need to have in your family, you need to have the right term life insurance. That's all you need for the correct term and also for the correct coverage. So if you don't have it, then please even don't even wait for your husband. Take an action, right? How do you do that? So the first thing is, if you're working and your husband is working, the employer also offer the basic and voluntary life insurance. So that's something you both can sign up, which is not that expensive. But again, that's not enough. Why? Because when you change your job, that will be inactive. So that's why definitely get an outside term life insurance for 20-year, 30-year, for 1 million, 1.5 million. So how do you know the right coverage, right? So the term has to cover until you retire. So let's say if you're planning to retire in 30 years, and buy a 30-year term life. And then the amount, how much it's, so is it 1 million or 2 million? So it depends how much mortgage you have, how many kids you have, because the college expenses, it's pretty expensive, right? The in-state for one kid is 150K, out of state maybe like or 250K. So if you have two kids, then add 500K. Then if you have any debt, car loan, education loan, or any loan debt, add that. And also, what's your yearly expenses, right? The family expenses. Let's say if it's a 50,000 or 100,000, let's add that. So if you add all those things, it can be easily anywhere from 1 million, 1.5 million, or 2 million. So you should take that coverage for that amount, and also get it from good companies. That's also very, very important. Okay. And then the move on to the next thing is very important, is a will and trust, right? And many of them doesn't do that, particularly if you have a minor kids under 18. at a minimum, do a will, so that when you do a will, you can nominate a guardian for your minor kids. Because that's very important. Because if you don't do that, then
இதுல
the
சொல்லி
court
Facebookல
will
போட்டேன்.
decide
வெப்சைட்ல
who is going to get the custody, right? Which is not a good thing. So that's why do a will, nominate your close friends or relatives, your parents, so they can get the custody. And along with that, you will also nominate executor who can take care of the assets.
கீழ இறங்காத.
Then, then besides that, you can
Don't
also do a
come down.
trust. Assuming if you have a lot of assets, then definitely you can do a trust. So by setting up the trust, you can avoid the probate process again, which is pretty expensive and costly. And again, whatever I've talked, right, the term life, usually it doesn't cost that much. We are talking about maybe less than $100 per month. And similarly, the will, I would say maybe like $600 something, or if you do a trust with an attorney, maybe like $2,000, $3,000, but it's just a one-time thing. But if you don't do that, then you are going to end up spending lots and lots of money. And like the in New York and California, it takes easily probate one, your primary home property can easily cost $50,000. And plus, it might take years to do that also. So that's why the proactive is best thing to do. So if you haven't done it, I would strongly recommend do it now. And also check with your employer. They offer the legal plan. Probably you pay like $5, $10, and you can hire an attorney to do it pretty much free of cost. So it doesn't cost that much. Okay. And then the next thing I want to focus is the financial scams. So unfortunately, every year, right, billions and billions of dollars are getting scammed, and millions of people are getting scammed. And particularly, they target single women who don't have that personal finance experience, or when they get older, or even educated people people like us, and people who are working in IT. You won't believe it. They lost lots and lots of money. What they do is, I'll go through a few example. So what they do is they ask contact through WhatsApp or Facebook. They ask you to join in some group to discuss the investment option. Then they will promise high returns. They'll say, I can double it, triple it without any risk. Um, Please run away. Don't join. Just block them straight through your face, because that's the only way you can escape from these scammers. Because unfortunately, even IT professionals and many educated people, they fall for this scam and lost lots and lots of money. Okay, and unfortunately, which is again, it's happening also every day. And also, there is a lot of online romance scams. They convince the victim to send cash. That's also happening. So please aware of it. And recently, you might have come across people calling from like an Indian embassy or IRS or Social Security Administration, and they try to scam the people. And also, they'll say you got to win a large prize, then you have to pay for it. Again, it's a scam. They sometimes they pretend like a relative or close friends, and they try to steal your social security and bank account details. So that's why it's very important to monitor your bank account frequently for any unauthorized transactions. And people scam with mortgages. So that's why the best thing is you need to aware, right? Always stay away from these guys. And finally, the AI generated scams it's getting more powerful. Actually, yesterday one article came in Wall Street. The AI based hackers are more powerful than human hackers. So think about, as the AI is getting more and more powerful, the Gen AI or agentic AI, I think the scams are going to be massive, and it's going to be more powerful. So that's why you have to be very careful. Otherwise, it can pretty much wipe out your all your hard-earned money, right? Okay. Then there are the next thing I want to quickly cover. I know we are getting very close to end of tax year, December 31st. but we still have few weeks. I want to quickly go through 12 tax ideas. I know you should have done this maybe January 1st, not now. But again, nevertheless, you still have few weeks. Try to implement these to save your taxes, because the saving taxes, not many people take it seriously. I'll quickly tell you the important. So if you look at this, right? So if you can save, let's say like a $10,000 tax savings every year, right? And look at that over 20, 30 years, just the tax saving itself, if you put it in like a S&P 500 index fund, it's closer to like $1.6 million, right? And I'll tell you, just quickly go through some of the personal tax strategies. Let's say if you can maximize your 401k, you can do 23,500, both husband and wife, and you can do, let's say, the traditional IRA, the HSA, we can do 8,550. And also some of the states offer the 529. You can do the Mega Roth 401k that you can go up to $70,000. So just the pre-tax strategy itself, look at that, right? If you are in even like a 24% tax bracket, that could easily save $15,000 taxes, right? So if you are doing that every year, think about that. The power of compounding will be massive. So that's why take a long-term view and try to implement these strategies to save taxes. So quickly, I'll go through these 12 strategies. As I said before, try to maximize your 401k. Don't just match what your employer matching. So you can do up to 23,500. And if you are age above 50, you can do another 7,500. And if you run a business, if you have a small business, then you can also do a SEP IRA or self-employed 401k that you can contribute up to $70,000 maximum, or you can also set up a defined pension benefit plan that you can do go up to 275K, and you can do the traditional IRA or backdoor Roth IRA. And let's say if you have a car you need for business purpose, I think this is a right time. Try to buy it before December 31st. If you buy it, the car weight above 6,000 pounds, as per the one big beautiful bill recently Congress passed, you can do the bonus depreciation 100%. So let's say if you're buying a $50,000 car, pretty much you can write off 40,000 in this year if you buy it before December 31st. Same thing, some of the real estate strategies. If you buy the real estate, whether short-term rental, long-term rental, and if you meet the eligibility, you can do a cost segregation and you can write off. The good thing is you can write off against your W-2 income, because typically when you're a W-2 employee, most of the time you can only do the 401k. But these strategies, and also you can open a LLC to manage this property and take an advantage of it. And if you have a huge capital gains, you can do opportunity zones investments to get the write-off. And also, if you expect or maybe 100K profit, then instead of simple LLC, go for a S corp, because that could help you to save self-employment taxes around $16,000. Then also, if you have a business, let's say if you are living in a higher tax state tax like California or New York, you can do a pass-through entity tax credit so that you can pay that state tax through your business, then you can write off. Then if you have research and development, you can also write off. The good thing is you can write off in this year the tax credit based on the tax bill passed. And you can also claim all the fringe benefits, which the insurance payments, your medical coverage, a lot of things you can pay as a valid expenses. And finally, you can set up a donor advisor fund, charity donation. Through that, you can also get a huge deduction. And finally, I would strongly recommend calculate your estimated taxes. And if you owe more to the IRS, let's say your withheld tax is lower, then try to pay it by December 31st so that you can avoid the 8% penalty and interest, because unfortunately it's a huge penalty currently, the interest charges. So at least you can save that also. So as I said, it's still not late. But if you need any help, you can reach out to me. I can help you to plan. You can use your own CPA. That's fine. At least I can do the planning and help you to implement these strategies to save taxes. Okay. So with that, so I'm going to start, move on to the actual our agenda topics, and I will have a Q&A for each topic. And also, I know we have kind of a limited time, so I may not be able to cover in depth. So that's why I'm sharing these links. Probably I'll put it in the chat window too. Um, so you can so I wrote an ebook, so whenever you have time, it's only like 20-30 pages, you can download and read it. This is the link. And also Mr. Vijay Mogan from Investment Insights and I did like a 2-day workshop specifically for women personal finance. So this is the link, so I'm going to put it in the chat so you can 1 second, so please bookmark it. And then whenever you have time, you can listen to it. I think it's going to be very helpful. Okay. So I believe you guys can see it, right? I think I pasted. Okay.
We don't see it in the chat.
Yeah, it's not in
I
the.
don't see it in the chat.
Yeah.
Okay, once again, let me do it again. It's okay, here it is. Chat. Why it's not? Second. Satya, are you able? Can you paste something? Anyone?
Let me copy paste
Or
something.
yeah, can you? I think the chat is enabled or should be able to.
I can copy paste.
You can do that. Okay. To all. Oh, okay, maybe to everyone. That's why. Oh, it's saying, okay, meeting group chat. That's why. Okay, here it is. Can you guys see it now?
Yes.
Okay. Thank you all. And again, yeah, if you couldn't access it, then please reach out to me. I'm happy to share because this one, it's almost 3 hours, 3 hour, like a 6 hour recording because it's a complete workshop. So whatever I'm going to cover today, it'll be in more detail as part of this workshop. So definitely during your free time, please, you can watch it since we won't be able to cover a more detail during today's session, right? So the first thing is it's very important for all of you guys, right? Definitely get a bank account, which is very, very important. Most of the time, probably your husband has his account or joint account, but I would strongly recommend set up your own checking and savings account. So that way you can handle, learn how to do a bank account, get a credit card, how to handle that, and also importantly, how to transfer the funds. And please do not outsource this to your husband because by hearing one thing, learning one thing, but when it comes to personal finance, doing it is very, very important. So you have to do it by yourself. So the more you do it, and it will be very, very easy. Again, it's not that complex at all. Then the second thing is learn how to make the digital payments. So get familiar with Zelle, Cash App, PayPal, Venmo, or whenever you go to India, you might have seen even road side sellers. They have the GPay, Paytm, Apple Pay, and if you run a business, then you can use like Wise, Beam, or Remitly. There are lots and lots of digital payments are available. And I think if you talk to your teenage kids, I think they're all using Cash App and all the other things, right, for transferring these. So that's where the world is going. I think in the next another a few years, I think you'll be surprised. It'll be more and more digital, right? So that's why it's very, very important to learn how to do that and also do it very carefully because all these digital payments, because if, these are all called electronic transfer payment. If you incorrectly send, then there is a very high probability you might lose your money. So that's why transfer maybe like $1 first, then confirm the intended recipient receive it, ask them and confirm if they received it, then transfer the remaining, right? Then always enable the two-factor authentication because that's very, very important, right? Um, because as I told you before, once the AI scam thing, I think God knows what's going to happen. That's why have all this security because the security is very, very important, right, to protect your funds and assets. And review your bank accounts at least weekly to check for any authorized transaction. Then alert your bank and file a claim report immediately. So that's very, very important. Okay. And then okay, I'll stop for, as I said, for every topic. Then, if anyone have any questions, please post your question in the chat, and Satya will read your questions, or you can unmute and ask your questions. Okay, so I'll pause for like a few minutes for every topic. So I want to have this as a more interactive. Because actually, just before this, I attended one entrepreneur event in Texas. Um, Actually, it's from Anita Chinnasamy. She's from Master. She's a product director from Mastercard. So right now, the Mastercard is working on it, agentic payments. So that means in the next few years, the AI agent is going to handle all the payments for you. For example, you'll say to the AI, okay, I want to reserve the tickets for, let's say, for a week. I want to travel to these places, book hotel. That's all you have to say, and the agents will take off everything. Okay, so and imagine Mastercard, Visa, all these big players are working on it. I know it'll take some time for users like us to use that because that's where the technology is going that fast, right? So that's why it's very important to understand. Again, money is a money; it's a hard-earned money, right? It's your responsibility to protect that, so that it's very important to learn all this technology and use it correctly. Any questions? Satya, if any question, yeah, you can stop me. You can read it, and you can
Yeah, I'm watching out for the questions.
watching. Okay. Yeah. Again, as I said, feel free to unmute. You can ask your questions. Okay. Then the next important topic is how to handle income and expenses and budget, right? So this is something another very, very important thing for your family financial success. And also it's a very, very easy to do it also. So first thing is you can open a spreadsheet, right? Calculate your estimated income, right? If you're working as a W-2 employee, you can find out from your pay stub or W-2 what's your take home after all the tax and deductions, right? And also find out how much interest income you're earning from your CDs or savings accounts or money market or T-bill. One more thing I would advise as an investment advisor, do not keep your money in the checking account because you're not going to earn anything, right? Even if it's an emergency savings, right? Keep it in CDs or high yield savings account because right now you'll get at least 3 to 3.5% interest, which is better, which is good, right? And also you can, it's a pretty liquid and like CDs and all, the banks cover up to 250K FDIC insurance. And anytime you can pull it and use it for your emergency needs. So that's why never keep anything in the checking which you don't get anything at all, which is a bad thing. So that means you're losing your money is losing value because the inflation. So right now in the US, the inflation is like 3%. And in India, the inflation is like 8% or higher. So that means every year by keeping your money in a cash account, you're actually losing every day, right? So don't do that mistake. Then you might get a dividend from your stocks or stock funds, and any gains from real estate or stocks. And if you're running a business, right, and account your business profit, and if you own a real estate investment properties, then include your rental income, or maybe you might have invested as a limited partners or some 1099 income or K1. So you have to include all the income, not just your salary, right? And again, another thing I would always advise, even if you are a full-time employee, that's the only source of income you have. Uh, Find a way to generate parallel income, right? So that's why. So how do you get that additional income, right? So first of all, you have to save money. So the next thing is, so calculate all your expenses. Okay, identify all your expenses, all the housing, transportation, food, and children's kids expenses, right? Then calculate the difference, right? So now you have all your income, all your expenses. It's a simple math, right? Find out the difference. So that's your savings. So that's why it's very important your expenses as always to be less than your income. That's what it's a budget. Budget is nothing but your income minus expenses, right? And you can do it in a lot of fancy ways. So I'll show you. If you want, you can reach out to me. I can share the spreadsheet. So if you look at this spreadsheet, right? So here you can capture all your income and whatever the expenses I already discussed with you, and you can track by month, right? And then on a monthly wise, you can see how much savings you are basically you are getting, right? So once you know your savings, right, then you can direct your savings to all the other investment I talked about, right? You can invest in these CDs if it's a if you need those funds maybe in 1 or 2 years. Obviously, you cannot put that in stocks or other high risk investments, right? So you can invest in the less risky investment. And but if you don't need for maybe like 5 year, 10 year, you can invest probably in like index funds, right? Again, if you don't have a time, don't venture out and play in the stocks. And again, I don't advise doing a day trading, options and margins, all those things. It's going to lead to a biggest disaster. And if your husband is doing that, please advise them. Over the long run, they are going to lose their wealth and also the health. Yeah, because that's what the research clearly shows, and I have seen with my many of my clients. So take always a long-term strategy. Just invest in low-cost and index funds. Do continuous savings and investments. So that will lead to long-term success. Or you can invest in the real estate properties so that it produce a rental income, and you also get a tax savings. Then not only that, it built equity over the a period of time, right? It's because if you look at in India, if you look at talk to your parents, right? Mostly they invest in real estate. That's how they manage, right? So that's why do all those things. You don't have to run a business, right? So these are the things you're putting your money so that it can earn an income for you. But again, if you're running a business or if you have some skills that you can utilize, then why not? You can start a business and that can produce your side income also, right? Um, so I'll stop here. Any
We
question?
have a, we have
Uh,
a question in the chat from Vivek Kapriya.
Sure. You can please read their questions. Or,
Can you share some insight on life insurance with cash value? Does that have more worth than 5 to 9 plan? Worth in
um,
sense means a better choice.
okay. So if your kids are very young, let's say if they are in kindergarten or elementary school, for education purpose, I would strongly recommend you can consider a 529, which is a good tool because I'll tell you the benefit. Since you are starting very early stage, the power of compounding will be good. And when you use these funds for your kids' education, you don't have to pay any money at all, right? And also now, based on the recent rule change, whatever reason, let's say if your kid end up not using these funds, up to $35,000 per kid, you can transfer from 529 to Roth IRA. Okay. And also, worst case, if your kids didn't use, you can always withdraw, and obviously you'll pay penalty 10% and taxes on just on the gains, right? But we all know if your kids are 100%, they're going to study in the U.S. But you know how expensive. I'm going to cover that in the down the slides because, as I said, the in-state itself like 150K, out of state 250K. It's a lot of money, right? So, and particularly by saving and investing through 529 and getting this a tax benefit, definitely it's a good way. And the other question, the insurance, all I said, right? All you need is the term life insurance. The other insurance, if you are going to do that, then hire a independent fiduciary advisor, okay, to validate whether something is suitable for your situation, because there are a lot of hidden costs and suitability issues. So I cannot simply recommend in this call whether that's the right thing to do. So that's why, because of there are a lot of hidden costs and a lot of things people don't disclose. They try to sell it for getting the commission and other costs, and many of the time it may not be the right thing for that family to get into it, right? So that's why when it comes to any financial products, please hire a fiduciary independent advisor, get their input before you sign up for those kind of investments. Okay. Any questions? Again, as I said, post your questions in the chat window, or you can unmute and ask your question.
We have another question from Gautami. Is it worth to take term insurance with living benefits?
Yes. So you can take term life insurance with a living benefit. Again, see, because sometimes they try to add more riders, what they call, and it's going to increase your premium too. So that's why when you add this accelerated benefit, see what makes sense, and then you can include that as long as the premiums are not too much for you to handle it. Okay. Any other question? Okay, if not, then I'll move on to the next topic. So this is another topic which is very, very important, managing your 401k, right? So every family, at least people who are living in the US, right? Most of your assets, by the time you get closer to retirement, it will be sitting in your 401k. It could be in millions, because even right now, you won't believe it. There are millions and million people have millions of dollars in 401k as of now. Okay. So because this is the money you're going to use it to manage your retirement life, right? So that means it's very, very important how to manage these accounts, because this is not like a simple bank account, which is easier to manage. Because this is something you need to know what funds you have to allocate, how to rebalance your 401k funds, right? So that's why I'm going to spend reasonably some good amount of time to kind of explain and walk through so that you can do it by yourself. So if you are not doing it, definitely learn. You have to do it, because at some point, this is going to be a very, very important thing for your life. Okay. So with that, so first thing is to understand, because these 401k, right? I'll quickly show you. So this actual screenshot. I know some of your 401k may be managed by like the brokerage could be Fidelity, Vanguard, Schwab. There are lots and lots of providers are like a principal, but the concepts are the same, right? So if you look at here, every 401k, they offer investment elections. So typically they will have a target date fund. So if the example I'm showing here, like a Vanguard target date funds, right? So 2015, 2025. So these numbers, it's nothing. So basically, these numbers are decided on when you're going to retire, right? Let's say if you're going to retire in 2040, then the recommendation is you can put your funds in 2040. So the people who don't have time and don't know how to manage this fund, so typically they do that, right? This is called target date fund. But again, these funds has its own risk too. So you have to see how much charge, because all these funds, right? There is a management fees. Um, Particularly the management fees, you might think it may not that much initially, but think about by the time you retire, when you have $1 million, even if the 1% fees, it's going to be $10,000, right? It's a huge, and also they are going to take every quarter, every month, every year, and it's all adds up too. So that's why you have to watch for the management fees, and it's prudent to invest in the low cost funds. Then also they have an index fund they offer, and also actively managed fund. So if you go to the next screenshot I'm showing here, as you can see, there is a Vanguard 500 index, right? This is a S&P 500 index fund. So typically the management fees is close to zero, actually, right? Um, then also you can see there are a lot of actively managed funds, like you can see growth funds, small cap, mid cap. Sometimes they charge like a 0.6% to 1%. And then the bottom you can see there is a stable value, that's a money market fund. So typically 20 to 30 funds they provide in the 401k. So you have to understand this is different from your bank account, right? Because all these funds provide you a return, but at the same time, it has a risk too. So you have to always understand this is not like your bank account, at least it's guaranteed up to 250K. It's not like that, right? So that's why I'm going to go back to the 401k fund types, right? So if you look at here, right? So we all know the cash, the money market, as I saw, even in the 401k has a money market. So if you move the money under that, at least you will be safe, right? So that's one. But again, you cannot put all your funds under this cash or money market, because it's not going to grow. Because the reason is the 401k is for your retirement, because you cannot pull out this money before age 59.5. Otherwise, you are going to pay 10% penalty and most likely like 25% tax bracket, based on whatever the top tax bracket you are in, based on your taxable income, right? Then also in 401k, they offer some of the inflation protected short-term bonds or medium bonds or long-term bonds. Again, these bonds, I know are particularly at least the inflation and short-term, the risk level is low, but as you can see, the return also will be low. It could be maybe 1 to 2%. Then also you have a long-term bond funds. The return is 3 to 4%, but you can see the risk is pretty moderate high. Uh, During COVID, exactly, people always think the bond are less risky, but during COVID, we all know what happened. The inflation gone to like a double digit, like a 10%, and these bond actually lost 30% of its value, right? Even though the return is 3%, think about it lost 30%. So that's why you have to be careful when you invest in even in the bond, because in during the inflation the bond risk is very 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 high, right? Then also you have the real estate REIT funds, so that provides like 8 to 10%. Again, the risk is high. And there is a equity funds, I think I show you the S&P 500, which offers maybe like a 10% annualized return, but again the risk is high. But again, even though the risk is high, right, the index fund, but over a long term, you can invest. Because when I say long term, I'm talking about 10-year, 20-year, 30-year, because all these retirement funds, right, it's all for the long term. So that's why you can invest in these index fund, so that you can get decent returns. I know the market will be volatile, right, during recession, or we also are during bubbles, or the market will be highly volatile. But keep your emotion. So that's why when it comes to investment, you have to manage your emotions very very good. Don't get panic. Don't try to time the market, pull out the money, because then you're going to lose lots and lots of money. So follow a discipline. So slowly you start gradually invest, right? Whether the market goes up or down doesn't matter. Focus on the over the long term. But when he gets close to retirement, so the reason I'm explaining all these nature of these funds, because at some point, right, you have to rebalance these funds, because when you're getting closer to retirement, you cannot keep all the 100% in even in the index fund, because which is high risky. Why? Because when you retire, because you need money, you have to withdraw the money, right? Because if, let's say, if you have a rental properties, um, I'm talking about, let's say, if you don't have 401k, for example, let's say if you have a rental property, after retirement, you're going to get your rental income. You can use that to cover your retirement expenses, right? So similarly, in your 401k, now what you have to do is when you get closer to retirement, you have to invest in a way so that it produce income similar to your retirement property, right? So how do you get the income? So you can either invest in the short-term money market funds for some amount that needed to cover maybe your one first year, second year, third year retirement expenses, or you can also invest in the short-term bond funds, or there is a dividend funds which can produce, you can give you a dividend. Typically the RET, real estate fund. Let's say you don't have time and energy to manage a real estate, you can invest in the real estate index fund, which kind of give kind of similar type of your rental income, right? So so that way it produces income, so that you withdraw that income to support your retirement expenses. Okay, so that's why it's very important to start doing yourself, changing the fund from one to another. So that's why I'm going to explain it here. So as I said, the allocation, right? So you can either go with the targeted retirement funds, depending on your age, or you can invest in the broad low cost index fund. I strongly recommend, if you don't have time, if you don't have the skill set to manage the individual stocks or actively manage portfolio, I would strongly recommend go with the index fund, because 95% of the investors, right, even superstar, they cannot beat these index funds return. Okay, and so how do you change the investments, right? So once you log into your account, right? As I said, I know the user interface might be different, but definitely you will see these options. You'll see the investments. Then once you click, then you can see whether you want to do a managed account or select target date fund or do it yourself, right? Then you can do it yourself. Then they will give you three options. Whether you want to change your investment elections for the future funds. So that means every paycheck what you're getting, right, you're contributing to your 401k, so that amounts will be invested according to your elections. Okay, then let's say you want to change whatever the current investments you have, then you select this option. Then let's say if you want to change from one investment to, let's say, five different fund, you can choose this election, right? Then once you select, then it will present kind of this type of screen, right? Whether you want to see all, I will manage on my own, right? Or you can do a select target date fund, or select. There are a lot of different options they provide. Let's say you want to manage yourself, then you can select this select fund. Then it's going to present you this screen. Okay, change investment election in the source. So that's where it's going to give you all these 20, 30 funds, right? Then here you're going to put, as I said, right, whatever the fund you want to put, you put 100%. Or let's say if you want to choose like a three funds, maybe one fund you'll say put 50%, 20%, 30%. But in total, you cannot go beyond 100%, right? So that's what on the top. All the total has to equal to 100%. So once you reach the 100%, then you can submit your election, right? So that's how you do the fund allocation. Then the next thing is, let's say you have a fund, let's say you have it in index fund. Now you're getting closer to retirement. Now you want to move maybe like 20% from your index fund to, let's say, money market, right? Then you will use this option. Click the exchange one investment. Then you choose the index fund. Then you can say you can put a percentage or you can put a dollar amount. let's say you want like $50,000, you can say 50,000, or you can also put a percentage, then click continue. Then on the target side, now you'll say on the buy, okay, what fund you want to direct your money, right? As I said, again, you'll have an opportunity to select the 30 options. So depending on your need, whether it's a money market, bond fund, or a real estate fund, you'll select that and then submit that. So that's how you manage your allocation. So that's why, based on my experience, I would recommend keep your investments very simple, right? I know they're offering 30. I know I've seen some people, they put money in all the 30 funds. And again, I don't think that's a right strategy either, right? It will be very, very difficult to manage all the 30 different funds, right? So that's why I would say maybe 3 or 4 funds. As I said, the low cost fund are which will be easier to manage, and any given time you can always log in and rebalance your portfolio according to your need. Because again, that's why we are calling the personal finance, right? Every family finance situation will be different, and what you're going through, the financial journey will be different. So based on that, you have to do this rebalancing accordingly. Okay. So as I said before, so you have to consider the return aspect, the risk aspect, and also the management fees aspect when it comes to these allocations. Okay. So I'll stop for a few minutes. Any question? Again, this is a very, very important. Trillions and trillions of dollars are in the 401k, and at some point you are going to inherit. And as I said, you also have to understand the tax implication down the road. And you can roll over this 401k into Roth. It's called Roth conversion. So that way, once you move to Roth, then you don't have to pay any taxes on gains. So that's a good thing about the Roth. But again, when do you do the Roth, right? When your taxable income is low, your tax rate is low, uh, probably that's the best time you can start doing. Or if you're paying less tax rate now, then what you can do is you can directly contribute to your Roth 401k instead of doing in the pre-tax 401k, because the tax plays a major role when it comes to these retirement accounts. Okay. Satya, if you have any questions, you can.
Question from Gayo. Yeah.
Mhm.
Investing in lump sum of $10K in S&P 500 versus 529 plan, which is beneficial? Suppose kid does higher education outside USA. Even after paying 10% penalty, is it worth investing in 529 plan?
Yeah, so
Yes.
the question is, no, never compare 529 and 401k. It's a totally two different thing, right? So the retirement, it's for you, right? For husband and wife. 529 is
Uh,
for your kids' education. So
Mari, actually, this
uh,
is Gayatri, and the
okay.
comparison is between S&P 500 versus 529 plan.
S&P
Um, uh,
500.
yeah,
Oh, okay.
S&P, like investing in an S&P 500 for 8 years
Uh-huh.
as a base of a 10K lump sum, and using
Mhm.
the same for in 529 plan for kids. So, so which would be beneficial after the tax, post
Oh, so
tax?
you're talking about like investing in the S&P 500 in a brokerage fund versus
Yes.
keeping it in 529,
Uh, yeah,
right?
yeah.
Okay.
Yes, yeah.
So okay. So even in that scenario, right? If I were you, I would go for the 529, assuming your kids are very young. It's better
Mm,
to because even in the 529, most of the states they offer the similar S&P 500 index funds too, right?
got it.
So what you can do is, because in the 529, typically just like 401k, they offer the enrollment based fund. So based on when your kid is going to start college, and also I've seen they also offer these index funds too. So I would recommend open a 529, then put your funds, contribute so that it will directly go to the S&P 500 fund. So that way, instead of you're doing the same thing in your brokerage fund, right?
Mm-mm.
Definitely your 529 will beat your brokerage fund, because you will not pay any taxes at all when you withdraw.
Got it.
right?
So, like in case if they do higher education outside USA, the penalty will be like on the capital gains, right? Capital gains.
Correct. That's
So,
correct. Yeah. So,
so
but
even
if
though
you're,
like
but
the
I
high
would
the
say,
charges will be high.
yeah, but I would
Yes,
say
please.
if your kid 100% going to study in India, then maybe
Mm-hmm.
you can do it in the brokerage account. If they are 100%, but if
Yeah.
you are 100% sure if they are going to study in the USA, then definitely go for
Mm.
a 529.
Got it. Got it. Thank you.
Mari, this
Thank
is Thiru. There is an
Um,
option called we can make it as a Roth withdrawal. Okay, if they don't use the 529, whatever leftover after like
Correct,
maybe
correct. Yeah,
15.
so
Yeah.
you. Yes, if
that's
they don't.
true. So yeah, anyway, as I said earlier, right, you can have a 529 at least up to 35K per kid because that can be moved to the Roth IRA for your kid, which is will be completely tax free.
Yes. Okay.
Okay.
Got it. Thank you. Thank you.
Okay. Thank you.
We have one more
Yeah.
question from Gautami Selvakumarsamy. So,
Mhm.
if we invest in 5 to 9, I heard kids won't get scholarship for colleges. Is that true?
Yeah, this is another question I keep getting. Actually, that's not true. So I will explain how your college, the financial planning works, all these scholarship and all, right? So once your kids get into, let's say, senior year, right? Then you submit the FAFSA application. Okay. So when you submit the FAFSA, they actually pull your tax return directly. Even you don't have to provide. They already have a integration with the IRS. They pull your tax return. Then they decide mostly based on your income, right? So in the FAFSA, they provide like a three sets of college funding. Okay, so one is need-based aid. Okay, so the need-based aid is purely based on the family income, right? But in order to qualify, the family income has to be below poverty line, which is usually $50,000, $60,000, right? So mostly our Indian family, we are not going to qualify for that. Okay, so the need-based aid, it doesn't matter whether you have a 529 or not, because your income itself make you disqualify for that, right? Then there is a merit-based aid. So that one, they don't look at all your financial situation at all, right? So that way, again, it doesn't matter whether you have a huge income or 529. So that the merit-based aid, it purely based on the merit will be decided, right? Then there is a third category is loans. The FAFSA provide subsidized loans, unsubsidized loan. Then there is a plus loan, or it's called parent loans, right? So the subsidized loan, so for loans, obviously they will take into consider income plus your 529. So if you have a 529, so maybe your kid may not be eligible for the subsidized loan, because the benefit of the subsidized loan, when you're, because the loans will be issued under your kid's name. So they are responsible for repaying the loans. But the good thing is, because it's given by the Department of Education, the subsidized loan, the kids, the student don't have to pay the interest accrued while they're in college. Let's say they are studying 4 year. So during the 4 year, whatever the interest accrued, that's why it's called subsidized loan, so that the kids doesn't have to pay, the government will cover that. But there is an unsubsidized loan, so it doesn't matter. The kids will be responsible for that. Then obviously, then there is a plus loans are parent. The parents will pay the loans back with interest, right? So to answer your question, so all this scholarship and all, so it doesn't matter in for our scenario. So that's why if your kids are younger and there is a very high probability, 100%, if they are going to study in the US, then I would still recommend go for the 529. But once your kids are in high school, I don't think having 529, it's not going to make a huge difference, because you don't have that timeline, so that the power of compounding will help you to grow your 529 funds. Okay. Next question.
Yeah, that's all I have for now.
That's all. Okay. So let's move on to the next topic. I know recently, probably all of you guys did this the employee benefit package. So at least for next year, so part of the employment, so your employer offered this benefit plan. So make sure that take an advantage of all these retirement plans. Please sign up because I'm seeing many of them may not do or may not contribute or contribute up to just the employer matching. So I would strongly recommend try to maximize. As I said earlier, it's going to help you to save a lot of taxes. And even if you're going to go back to India, it's your money. You can, it will be useful for your retirement. And besides signing up with these medical plans, definitely sign up for this voluntary supplemental life insurance. As I said before, unfortunately, in our community, people don't have this term life insurance outside. So that's why it's very important to sign up, and it doesn't cost that much. But definitely have one outside also. That's very important. Because all these things, right? The employer, they offer the AD&D, the spouse life, short-term life disability, long-term disability, legal plan, and typically it doesn't cost that much. So I would strongly recommend go through each and every item and sign up because it does provide a huge upside for you and your family. Okay. And then the second thing, I think we kind of discussed a lot as part of the 529, but anyway, I'll go through that. So ask your kids before they decide the college, right? Ask them to do a lot of research because you're going to spend lots and lots of money on this college. Find out what kind of a program and courses that college offer, and ask them to talk to the past students or current students. Find out the college teachers' performance, because the teaching quality because that matters a lot, right? And check the rate my professors and find out the ratings and find out that the college has a good alumni network and whether they provide the internship job opportunities, the quality of education compared to other colleges, and finally the cost, right? Because as I said earlier, it's a pretty expensive. If you're sending it to private colleges, it's easily cost 300, 400, $500,000 easily for a 4-year degree. So find out how you're going to come up with money to support that, right? So have an open conversation with your kids. So I have few recommendation you can try. Uh, Ask your kids to apply for a scholarship. So this is not from the college. This is outside scholarship from endowments from your state, from your local counties, right? And ask your kids to check out the scholarship through these websites, College Board, FastWeb, scholarship.com. There are a lot of websites they offer the scholarship. Then you can also doing these 529, which we discussed in more detail. Then I talked about the FAFSA. So definitely during the final year, submit the FAFSA so that you might get qualified for these need-based, merit-based, or the subsidized loans. And I would recommend ask your kids to at least get apply for some of the loans, even like 5,000, because so that way they'll have skin in the game, right? So now they are responsible to complete their college, and then once they get a job, so that they can repay, right? And by the way, they can also learn all these financial concepts, and they'll also build their credit score by having this small amount of student loan. It's not a bad thing. Okay. And also, I would recommend you to consider, let's say, if your kids end up going for out of state, which is very expensive. So find a way to convert out of state to in state. So because many universities, they do, at least the public universities, they have this residency classification. But I know they don't advertise because they might lose the revenue. But talk to the college counselor, find out the rules. I think you can work on it to get that eligibility. Then once your kid goes for the second year, then you can apply for the residency classification so that you can at least save the next 3 years of tuition cost, right? Um, so yeah, in the FAFSA, it's a pretty standard application. So you have to submit your tax return, your income information, your bank. But the good thing is you don't have to disclose your retirement accounts, your primary home, so that it'll make you better eligible. So all you have to disclose your brokerage account, bank account. If you have a business, then you have to disclose your business profit, all those things. Okay. So with that, then the next thing is the tax. And recently I did a session. So this is the a link I have. I can put it in the chat window. So whenever you have time, you can uh, watch this session, and I think it can help you to save a lot of taxes because recently Congress passed a bill. I think that definitely it can help you or save a lot of taxes. So I can quickly run through. So for personal, they increase some of the standard deduction, and then the child tax credit increased to $2,200. And even if you have a car loan, even if you don't have a business, I think you can also now deduct the loan interest cost. Then if you have a overtime, if you're a non-exempt employee, you can get a exemption. And if you are paying a higher state taxes, I think now you can climb up to 40,000. Or if you have a business, you can also use the PTE credit option. And the estate tax has been increased to 15 million. And for the businesses, the qualified business income, the QBI, they made it permanent, 20% of it. And as I said earlier, the bonus depreciation, now it's 100%. And then if you are doing any manufacturing business, you can do 100% of including everything because the government is promoting the manufacturing businesses now. And if you have a C Corp, actually you can do a write-off up to $15 million. And as I said earlier, the R&D expenses can be claimed 100% in the year one. And if you have a capital gain, you can use the OC opportunity zones and set up the right entity. And so, as I said before, right, what kind of entity is matters so that that can save you a lot of taxes. Um, Okay, and yeah, so these are the tax savings tools for your if you're in a W-2 employee. So typically, I strongly recommend do at least the 401k, IRA, HSA because that itself can save you a lot of money. And if you have a business, then definitely go for all the other strategies which I explained it before. Yeah, definitely watch the recording I just now shared because it's lots of information, right? And also the another area, if you want a diversification, go for a real estate. You can either do a direct real estate investments, a residential property, commercial property, because that helps with the tax savings, and you can build an equity over the period. And I know the interest rates are going down. I think if you're paying a higher mortgage, I think maybe for this is the time start refinancing. I think you can definitely save huge interest cost. Um, okay. So with that, I will stop here and we can have our final Q&A. You can unmute and ask your questions. And as I said,
Yeah.
if you need any help with your business tax, personal tax, feel free to reach out to me. We can provide complete CPA tax planning, CFO services, along with that personal finance. If you need any help with your retirement planning, financial planning, or if you want to move assets, fund repatriation from India to here, we have a chartered account in India. We can help you with that process, or if you need any help with the investment due diligence, or estate planning help, or kids financial planning help, we can help you. I'm sorry. Yeah, please go ahead. Yeah.
Yeah, we have a question from Satish Atiraj. So
Mhm.
the question is, can you please clarify when we should go for Roth 401k versus traditional 401k? Any guiding principle to decide?
Yeah, so if your tax rate is low, when I say maybe like a 12% range, or let's say using all these strategies, if you can bring down your taxable income, then you can go for a Roth 401k now. But let's say if your tax bracket is, let's say, 37% or 35%, which is a very higher tax bracket, then I would recommend go for a traditional, the pre-tax 401k, because the tax deferred growth over the long run, right? It beats your after-tax growth, right? So that's how you have to make the decision, whether to go for a Roth 401k or the pre-tax. But also, I would recommend what you can do is, because nowadays many employers offer after-tax 401k contribution. So you can do your employee contribution up to 23,500 using your traditional 401k. Then what you can do is, there is also after-tax 401k. Then you can contribute, remember that amount, you can totally go up to $70,000, right? So that means that $70,000 minus the 23,500 minus your employer matching, the remaining maybe up to 30,000, 40,000, you can put it under this after-tax 401k, which will automatically converted into your Roth 401k, which is called the Mega Roth 401k. And many of them might not be aware of it. So that maybe that's the even a better strategy. You can pump more money into your Roth 401k. And besides that, you can also do the backdoor Roth IRA. Let's assume if your income is so high, you cannot do the Roth IRA directly, which is $7,000, but you can still do a backdoor Roth IRA. First, you contribute to your traditional IRA first, then you transfer from traditional IRA to a Roth IRA. So that's how you do that.
One more follow-up question on the Roth IRA.
Mhm.
Can you explain a little about 401k Gold IRA?
401k, what do you mean by gold IRA? Like a self-direct, I'm assuming they're talking about like a self-directed IRA. So you can invest in gold or pretty much any assets, I believe. Is that what their question?
Gayatri, is that you want to add
Is that?
something to the question?
Yes, yes.
That's okay. Yeah, so these self-directed IRA, you have to be very careful unless you have the skills to invest in the other areas. Because even you can invest your 401k in the self-directed IRA, you can invest in real estate or gold or crypto, could be anything, right? But you have to be very careful unless you have the skill set and emotions to handle these kind of assets. You might lose all the money, right? So that's why if you don't have time, if you don't have the skills and emotions to handle, I would recommend just limit to the regular 401k instead of moving to these kind of self-directed IRAs. Because what I've seen, and also there is a huge hidden cost, management costs and fees involved with these self-directed IRA. So that's why please use it with caution. And also, I've seen some of the 401k. There is also brokerage 401k. What they do is move all the 401k into kind of a brokerage account and then invest in these stocks and the high risky stuff. I would strongly recommend don't do that, because over the period there is a very high probability you are going to lose lots and lots of money. That's what happened with many investors. So, as I said again before, I keep repeating that. Keep it simple. If you want to be successful, keep it very, very simple. Invest in these low cost index funds or the real estate, or maybe the rental properties. Just invest what you are comfortable, what you know, right? Don't, because many people they feel the greed will overtake and they are becoming overconfident, and then over the period they end up losing everything. Yeah. Any
Yeah, one more question. So I have after-tax money in regular IRA. Can I move the money to Roth IRA? Can it be reflected in the tax filing in such a way that the regular IRA is not assumed before tax money?
Yeah, so in that scenario, what you have to do is, if you already have some IRA, then you may have to move that into your 401k, then do the backdoor. I'm assuming they are asking for the backdoor purpose. Otherwise, we already have an IRA and then do the backdoor. Then the IRS will do some prorate taxes they will charge. But if you don't have any IRA, then you should be able to use the strategy what I explained, the backdoor Roth IRA. And also the other thing what you can do is whenever your taxable income is low, your tax rate is low, then you can at least the prior employer 401k, right? So you can start converting that into your it's called Roth conversion. So you can slowly start moving to a Roth IRA since there is no penalty for that, and also your taxes will be maybe like a 12%, which is not that big since now you have 10, 20 years from now, so that the power of compounding under a Roth will be huge. So that when you retire, you don't have to pay zero taxes, right? Which is a good thing for you. Okay.
And one more concern is Aarti is saying that the Google Docs link that you shared earlier, she's saying it's not accessible.
Okay. Or yeah, just ping me offline. I can fix it, and I can share that link. So you can feel free to reach out to me. So my WhatsApp number is 301-758-4052, or my email mari@samatva.us. And also I'm recording this session, and yeah, if you need the recording, I'll share the recording and these presentation slides and some of the templates I have. If you need, please reach out to me. I'm happy to share it with you guys.
Yeah, this is Balaji here. I do have one more question. Thanks for all these insights. I know, like from the market overall market perspective, we see India is also growing. So, is it worthwhile to consider doing some investment in India apart from buying land or gold into the mutual funds market, or what could be your suggestions? Knowing that we will be long term here, is it worthwhile to consider investment back in India or pipeline to in one place?
Yeah, again, I normally recommend have at least like a 20% investment in the international market, which India also comes under that, because the US, right? If you look at right now, because the market gone up so high, particularly the seven companies, right? Even the S&P 500 itself, I think I would say maybe like 40% of it. But again, as I said before, it will go through volatility. But maybe for India, I think it's not a bad idea to invest maybe like a 10% of it in. And also, I would the one thing you have to consider is instead of moving money from here to invest, let's say if you already have some money in India, then I would recommend you can invest that money, open a demat account, invest, and in India also you can invest in the Indian index funds, right? Or maybe gold also. So some 10% of it, it's not a bad idea. Because the one thing is moving money from here to there, that the exchange rate loss is pretty high, right? Because like 20 years back, it was 30, 40 rupees. Now, 90 rupees now, right? So when you try to then move it back, you're going to lose in the exchange rate. And also, when it comes to the real estate, uh, if you are going to settle here, then I wouldn't recommend heavily investing in real estate in India, because the problem with that is, let's say if you're going to settle 100% here and you have too much real estate there are a lot of bureaucratic paperwork and process, and also now we have to deal with both countries' taxes, and after some time you may not have anyone to take care of those properties. So there are a lot of logistical problems you will be facing down the road. But if you are going to settle in India, then definitely yes, you can invest in India, the real estate or the index funds in India. Definitely is a good idea.
Perfect. Thank you.
Mhm. Thank you.
Hi, Mari.
One more. Yeah,
Sukumar.
go ahead.
Can I open a brokerage account for my kid? If yes, is there any limit for it? And my second question is, in what way we can save tax on it from a investment perspective for a kid.
So I'm assuming your kid is a minor, right? Under 18?
Yes.
Okay. So for kids, I would recommend a few things. If they are making any earned income, right? Let's say if you have some small business, then you can issue a payroll or 1099 so that to your kids for helping your business. So then they can take that money and open a Roth IRA minor account for them. Because in the Roth IRA rule is you have to put only the earned income so that whenever they make money, if they do internship or do whatever the work they do, if they earn some money, as a parent, you can open a Roth IRA youth. You will be the custodian for your kid, and you can put that money and ask them to invest in index funds, or they can start learning, right? Even if they lose, it's not going to kill them. It's just they can learn a lot. And also, what you can do is, other than the Roth IRA, they can also do the Fidelity and other. They are also giving a youth account, so you can open the brokerage youth accounts, and you can give them money, and they can invest, and they can also start learn how to invest. Okay.
We have
Next question.
one more question from Aarti. People are buying gold coin here at comparatively a lower price than in India. Is it really worth to buy it here than in India, and paying tax in India when we get it there? Is it a good
Yeah,
investment?
I think you will have a lot of logistical challenges, particularly gold coin, and now the customs and all, it's very strict. You cannot carry the gold coin. I think you have to end up paying GST and heavily, right? So I would recommend, if you're planning to take it to India, I would strongly recommend don't do that. But as an investment, if you want, you can buy and keep it. But again, the gold coin, now it comes to the custody, right? Then you need to buy a locker because it's not safe to keep it in home. So the other option is there is a gold ETF is available. So if you are not comfortable holding the physical asset gold, then you can invest in these ETFs, some percentage, so that it's like S&P 500 ETF. So you can liquidate anytime if you want.
Next question, which is better, 529 or UGMA or UTMA accounts for minors?
Yeah, I think as I said earlier, if your kids are very young, I'd definitely go for 529. If not, then you can go for the UTMA or other minor brokerage accounts.
Satish is saying the reality is that most of us do not have the clarity on where we are going to settle due to various immigration uncertainty. I understand this is very subjective, but do you have any general direction or advice from an investment standpoint?
Yeah, that's a great question. I know it's unfortunately nobody can answer the immigration side of it, but I would recommend as an advisor, right? Set aside that's totally separate. Don't bring that into the equation for the investments on into your personal finance, right? So think about um, you are going to retire no matter what, whether you are going to settle in India or USA, right? At some point, you are going to retire, and you need these retirement savings to support your retirement life. So approach in that way. So that means, guess what? Now you are making money here, right? So I would strongly recommend, okay, find a way to minimize your taxes, because I know what I am finding is, even though people are working in IT making money, but they end up paying huge amount to taxes, right? So try to find a way to minimize your taxes, because that's itself it's a huge saving. Now you can redirect that into an investments, right? So as long as you are here, I would recommend invest the funds here, right? And so that whether it's in your 401k, IRA, HSA, or your brokerage accounts, or your real estate properties, or business, it doesn't matter, right? You continue to invest, right? And then let's say even if you end up going to India, then your investment is going to continue to grow, right? And in fact, by having assets here, now you're also not only getting these returns from the investment, because the dollar rate, it's going to help you when you even go to India too, right? So it's kind of you're getting kind of a double returns. So then you can always find a way to minimize the taxes. The good thing is whether you settle in India or here, the India and US are part of a double tax treaty, so you don't have to pay double tax at any time. So if you pay taxes here, or you end up to either paying in one of the countries, right? So you kind of try implement these strategies in a way a little bit smartly so that you can minimize your tax impacts over the long run. So to answer your question, so I know it's very what I can say uncertain when you will get green card, all this H-1B situation and stuff. But I would recommend when it comes to personal finance, don't confuse with that. Um, Plan your budget well. Try to save as much as you can. Try to save, minimize your taxes. Then invest those, right? So that that the investments can also bring additional income for you, so that it doesn't matter whether you end up settle in US or India. At least you will have a better retirement life, right? You will take care of your retirement expenses well. So that will be my recommendation. Okay. Next question.
Yeah, that's all in the chat. We
Okay.
got some questions in the Google form during registration. I think most of it is already covered. I'll just read one or two from it, which is not covered. Like, tips to sell properties in India and transfer money here.
Yeah, so the properties, as I said before, it is a pretty compliance you have to follow. Unfortunately, because of the nature of uh, paperwork needed. Let's say if you're, and also you have to understand whether if you're selling your property or it's a inherited property, because the tax rules are different. As an NRI, they will withhold the TDS when you sell the property. Then you have to file the taxes, so that if you paid excess taxes, then you can get the refund. And let's say if you decide to repatriate, then definitely you have to work with a chartered accountant to file the 15 CA and CB form. Then not only that, then you have to report that income in the USA too. Then let's say if you paid additional taxes in India, then the good thing is you can show that as a claim as a foreign income tax credit. So that can help you to offset. But let's say maybe if it's an inherited property, then in India you may not have paid taxes. But here also it's a step-up basis, right? So your taxes will be calculated accordingly. And sometimes it makes sense. Maybe your parents sell the property and they can gift to you. So that way you don't have to pay taxes, but then you have to still do the gift disclosure. So I did one separate session just for this NRI fund repatriation. It is in my ebook. You can read it, and I have the recorded link also. So I would strongly watch that session. I think it can help you. And also, if you need any help, you can reach out to me, and we can help you on that. Okay.
I got one question in the chat. If
Mhm.
it is recommended to put more than 6% to 401k, will that be possible to get that after retirements? Is converting to Roth IRA the best option? I heard that there will be penalty if we keep 401k amount for a long time after retirement.
Correct. Yeah. To answer the question, right? So there is one call, it's a RMD, record minimum distribution, but that will start only from age 73 or 74. So you have, as I said before, I think the strategy, what you have to do is whenever your taxable income is low, tax rate is low, try to do the Roth, right? Then during the progression, right, until you retire, whenever there is an opportunity, right? And as I said, there are a lot of tax strategies you can use to minimize your taxes. So that during those years, you can do this Roth conversion. Or then you have to wait until you retire. So once you retire, let's say 60, then assuming you don't have any other income, then you can maybe take, let's say, for example, 100K or 130K. By withdrawing 130K, your standard deduction 30K, so your taxable income is like 100K. So you will be still, your taxable rate is like 12%. So that you move that into your Roth IRA. So you can do that for another from like a 60 years to 73 years, that you can shift huge amounts from your pre-tax 401k to your Roth bucket. So that's how people do that.
A follow-up question on that is when to change traditional IRA to Roth IRA?
Again, I think I just now answered the question. Yeah. So it's again, whenever your tax, it's all specific to your individual situation. If your tax rate is 37%, maybe it's not a wise idea to do that conversion. So if your tax rate is low, you can do it. So you need to have that planning to do that. Okay. And any questions? That's it.
Yeah, that's it.
Okay. I hope this session was helpful to you all. So as I said again, all right, this 1 hour session, definitely it's not sufficient, mainly for women who are attending this session. So I already shared the workshop recording with Vijay Mohan. You have to do it. And again, it's not a rocket science. Please start today, right? Start slowly, open a bank account, slowly start handling by yourself. And also, as I said, these 401k, so slowly start doing. By doing it, you are going to learn it. And as I said, keep it very simple. I think it's going to have a very, very long, you will have a long-term benefit for you and your family. And I think you'll thank me a lot in the future. I can see, because I'm literally working with single moms. I can clearly see their pain, emotional pain. It's very sad. So that's why the main purpose, I think, we are doing this session. So please take an advantage of it. I think you'll do fine. Again, it's pretty easy. Don't scare. You guys will be able to do that. Okay. With that, again, I want to thank SoCal, our Tamil nonprofit, for providing this opportunity. I hope it will benefit your members. Thank you, Satya and Sukumar.
Thank you so much. It was a really informative session and a very engaging session indeed. Thank you so much.
Okay. Thank you. Okay. With that, then I think we will close our session. Thank you all.
Thank you.
Thank you.
Thank you. Bye.
Thank you.
Thank you.
Thank you.
So I'll stop the recording here.
Thank you.